Okay, now it's time for Josh Young's Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Josh, you know you have to answer for this one. Your first pro pick is Journey Energy, Joy on the TSX. And really, it's been anything but as a shareholder. It has just constantly grinded lower. We got a lot of questions on this, including from Randy on X. Why did you go active on Joy? And what do you hope to accomplish now? So you're not somebody who's sanguine, I guess, about how much of an underperformer Journey has been, but you're still around in this name and you think there's value to be unlocked. Take me through your thinking.
Yeah, I mean, this is one of those where the management team had a great track record coming into it, and they had a set of really tough assets to start, and they did a good job, in my view, over the first few years of trading out of underperforming assets and into assets with a lot of promise. And when we had that hostile bid for Iron Bridge, which was the renamed RMP, we had been pushing pretty aggressively towards building out power generation, hosting Bitcoin mining, and just generally improving economics on gas assets that we had that were net negative, essentially, because between the low gas price and then the processing and transport costs, there was this big opportunity. So we went and pushed pretty hard on a couple of other companies that we invested in, including Journey, which we were the, I think, largest shareholder in at the time, to go do power generation build out, and then also to accelerate their Duvernay shale project. And so as they worked towards that, oil prices collapsed during COVID, and they were able to restructure their debt, which was good. But the difference in trajectory for the company sort of pre-COVID and in the first little bit after COVID versus what we saw later was really disappointing. It sort of looks like they, I don't want to speculate on what happened exactly, but there is sort of a measurable difference. And in the last few years, their capital efficiency has fallen. There have been huge delays on these power projects that, frankly, they were so early on that there should not have been these sorts of delays. Now there's lots of gas projects with cost overruns and delays, but 3 years ago, that was not really an issue. And these things should have come on. And we put out analysis. We actually can't find where all the money went, which is a real concern. And and haven't put out publicly thought there would be a response, and just silence, which is again like really sort of odd for a public company to just sort of ignore.
So
and then,
I mean,
yeah.
Well, I was just going to say, that's normally we don't hear about this for somebody who's like, this is my top investment idea. So
yeah.
Why don't you just sell it and walk away? Why are you still in this name? And what do you think can be unlocked?
Well, let me share one more risk, and then I'll tell you why we've been buying more of it. So the one more risk is that the chairman was the CEO of Zargon, which was overpromising and had similar cost overrun issues and collapsed and went bankrupt. And so, so why
you are
why
not
are we still
selling
in the
this,
name?
Josh?
Sorry, what's that?
Said you are not selling this, Josh.
I'm not. Okay, so why are we in the name? So one, there was a management shakeup at AIMCO, or at least a board shakeup at AIMCO. And their board was replaced because they were spending too much and getting too little. And it appears that AIMCO has been supportive of Journey's management and board so far publicly, which is a very big difference from what's happened actually at Aimco. And now there's this whole national conversation in Canada about pension funds and, where does Alberta fit in and so on. And I think there will be a lot more changes at Aimco probably soon. And I think that may shift to a very different governance approach for their local investments, particularly Journey, which has so many similarities to Aimco itself in terms of the governance and management and compensation and so on. So one, I think there's without our involvement at all, I think there's already this impetus towards Aimco portfolio positions and towards their management style. Frankly, it's surprising that there hasn't been more change, I think, at the staff level for Aimco. But typically, it's similar to Suncor, where Rich Kruger comes in and has a mandate for change, and you'll have a little while where some of the same people are there and some of the same bad stuff happens, and then you see radical change that's substantial. And I'm optimistic for Aimco that changes, and I think that may lead to substantial positive changes at Journey for their board and management.
And how much can? Well, I was just going to say, how much can be unlocked?
Yeah, so that's the real story, right? So the conventional assets have hundreds of millions of barrels of recoverable potential reserves, which is phenomenal. And when you look at the history of low decline oil assets and low decline gas assets, those get very high valuations in high points of cycles and very low valuations and low points of cycles. And so just those conventional assets could be worth 5 or 10 times where the shares are trading today, just in a higher price environment. So that's sort of that right tail upside. But then you have the power gen, which should eventually come on. And as that eventually comes on, that could be worth roughly the entire market capitalization currently. And then you have their Duvernay, where they're in with the Spartan guys, who are brilliant and have done extraordinarily well and created huge value for their shareholders over many entities. And that value creation is already happening, where you asked about Baytex before. The difference in between well results for Baytex and very close, the well results for Spartan, is night and day, and the Spartan wells keep getting better and better. So just the Duvernay asset over time could actually be worth as much as the market cap too. So you have this just enormous potential value and potentially actually enormous current liquidation value stuck in this legacy sort of governance mess, tied into this Alberta pension governance mess. But the Alberta pension governance mess is getting fixed, and I think that flows down. And again, independent of our involvement or sort of identifying some of these issues publicly, I think this would already sort of take care of itself to some extent. And I think if that could get accelerated a little bit, that would be wonderful.
Okay, so let's go to your second pick, maybe a little less complicated story, but certainly the stock has underperformed, and that's Ensign Energy Services, ticker ESI. It's down, and I think there's some concerns about deleveraging, their ability to pay down debt. Talk to me about why you like this one. It's a driller.
Yeah, it's a drilling rig company. So this one is really simple. So it's over 30% owned by Murray Edwards, who I have nothing but good things to say about, and who is enormously rewarded in the public markets across, at this point, virtually every other public entity that he controls other than Ensign. And so for anyone that says, hey, Canadian Natural Resources is such a great company and so well managed, and look at Murray Edwards, he's so great, and look at this approach towards managing a company, I would say, hey, you could buy Canadian Natural Resources at 7 times EBITDA and low teens or high single digit free cash flow yield and roughly in line with their replacement cost, or you can buy Ensign at a 30 or 40 or more % free cash flow yield to the equity and at a third of book value and a fifth or a seventh of replacement cost. And they've paid down more debt in the last 3.5 years than they have in market cap right now. So I think people just don't look at it because they think of it in the back of their mind as an over-levered company, even though they've been extremely successful in rapidly delevering. And people hate drilling rigs, and they don't like companies they perceive as over-levered. And they look at the stock price and say, hey, this hasn't gone anywhere, and there's no buybacks because they're paying off debt. And yet, here you have a Murray Edwards controlled entity, and the number two shareholder is Fairfax, and they've actually increased their position a lot recently too. And that's sort of the Canadian Berkshire Hathaway, arguably better, right? They've done a lot better than Berkshire in the last 5 years, and so between them, I think. The joke is actually for Ensign that all it's going to take is someone getting on, BNN or CNBC or something and clicking their heels 3 times and saying Murray Edwards, Murray Edwards, Murray Edwards, and the stock will skyrocket as they rediscover that this thing exists at this tiny fraction of where Canadian Natural Resources trades. So that's the joke. We'll see what happens with it. And I guess just the last thing, just mechanically, mathematically, and theoretically, as the company goes and delevers, even if it pays off debt slower and goes to, let's say, $150 million a year of debt pay down instead of 200 because of the slowdown in the drilling rig business, and even if there isn't a big recovery in commodity prices or whatever, that $150 million a year in debt pay down translates to somewhere around 50 cents per share of essentially market cap equivalent for a roughly $2 a share stock. And so just the debt pay down should unlock at least 50 cents a share in value every year. But then as it progresses, one, there's more free cash because there's less interest paid to be able to buy back more stock or pay down even more debt. And then two, it gets less levered, but it doesn't reduce its intrinsic value. Like that replacement cost measure is still there. They're maintaining their rigs. They're maintaining their ability to generate cash flow. So, really interesting sort of mathematically and sort of a deep value, very easy to own company with a lot of asymmetric upside and a lot of asset value protecting the downside. And then you have this just right tail potential, which is the market wakes up one day and says, hey, let's not pay 7 times EBITDA for a Murray Edwards entity, or 10 times like his copper miner, or I don't know how much for his space company. Let's go buy this driller at under 3 times EBITDA and at less than, what is it, like 1 times price to cash flow. So I think there is that real right tail potential.
Well, you did click your heels 3 times on In the Money, so we'll see what our power is at the end of this podcast. And you're right, Murray Edwards and Prem Watsa's Fairfax, they own about 40% of this company, a little bit more than 40%. But come down to fundamentals, and you said everyone hates drillers. It's because, as you said earlier in the podcast, what's the cure for low prices? It's low prices. And how do you get there? You stop your activity. Right? So if production activity is going to be lower, drilling activity is going to be lower, what's to get excited about the actual business, not the multiple, not who owns it, the actual business of Ensign?
Yeah, I mean, that's a great question. I think that's the problem sort of across the land drilling rig space. So there's 2 things. One, we're probably closer to the bottom than the top in terms of the global rig count, as well as the domestic US and Canadian rig count. When you look at past cycles and you look at sort of how low things have gone, and you look at drilling rig efficiencies and so on, it doesn't look very likely that we go down very much more. The current activity level in oil and gas in the US is low enough that we're already seeing some production declines based on real-time data versus the start of the year. We're down roughly a few 100,000 barrels a day for crude oil. It's not in the EIA weekly numbers, but you're starting to see it in some of the satellite data and some of the other data. And so we'll see. Like, it's possible that gets revised up, but we're seeing production start to decline. We're seeing more and more demand for natural gas, especially in the US, but also in Canada. And so I think we're sort of hitting that tail end of drilling efficiencies just as is. As prices eventually rebound, and this one might be a little more tied, let's say the upside prospects for the business might be more tied to potential recovery in oil and strength in natural gas. But as we see that, we could see the drilling rig count rebound pretty substantially, and Ensign would be one of the biggest beneficiaries of that because of their financial and operating leverage. So I think I don't know if we've bottomed from a drilling rig perspective, but we're getting close. And I think importantly, these guys have paid off so much debt in the last few years that while the market might view them as having some sort of debt issue, I'd imagine at their lenders, they're a hero for, paying high interest, but also having paid off 600 million of debt in the last few years. And when you pay off that much debt, you become a very high value borrower, and you buy yourself a lot of room to be able to extend for quite a bit of time. So I don't see there being a real debt issue. And if anything, maybe they just move, like I was referencing, from paying off 200 million of debt a year to 150 or something, which is still a huge amount of debt relative to their market cap and relative to their overall debt level.
Okay, let's get to your third pick. It's Vital Energy, and you're consistent. This is another beaten up name. It's down 50% in 2025, ticker VTLE on the New York Stock Exchange. Why do you like it?
Yeah, so they did a number of acquisitions countercyclically. They bought assets that people didn't like that were relatively high cost, and people didn't stick around to see what would happen and sold them off. And then at the start of the year, they did some exploration that was unsuccessful. And I think people took the costs from that exploration and applied it to their development, I think incorrectly. And when you have a stock sell off, I think the presumption is or the general market behavior is to shoot first and ask questions later. So it's been very interesting because we've gotten to buy more of the stock at a really low price, where the operations have actually improved dramatically, and the valuation is just wild here. But people got sort of distracted by this poor exploration effort and this poor result. So as these operations continue to do well, we think that the stock will start to reflect that. And this thing is wildly inexpensive versus its comps, and could trade up multiple times just to trade in line with some of the other small to medium sized publicly traded Permian producers.
Okay, Josh, it has been an absolute pleasure speaking with you. Thank you so much for joining us on the podcast. That's Josh Young of Bison Interests joining me.